everybody, welcome to a new video at the start of the week. Julius de Kempenaer here, presenting from Amsterdam in the Netherlands. No set schedule today. I want to go over a bunch of RRGs to see if we can make up what's going on in these markets, analyze some rotations, starting at asset allocation level, go to sector rotation, see if we can make it through some individual groups and more specific rotations. So without further ado, let's kick off with a look at the rotations for various asset classes. And I've got the one on the screen here. This is the one that you are used to by now. Again, Bitcoin I have ticked off because it is way out of whack with all the others. On the weekly chart, it's going through some sort of a deterioration, a weaker rotation, but on the dailies, it's already back up. So I'm going to leave that alone for now. But I want to focus on what's going on in the most important rotations, is that between stocks and bonds. And what we've highlighted a few times already in the last couple of weeks is the deterioration and the reversal that was visible in the stock-bond ratio. And it is getting more and more clear on this RRG that stocks are out of favor, although they are still on the right-hand side. So the longer-term trend, for now, is still in favor of stocks. But you can see how SPY has been rotating out of favor. It's now inside the weakening quadrant, and it's moving at a negative RRG heading, which means that it is between 180 and 270 degrees, so pointing to the southwest. On the opposite side, we found the fixed income tails, and they're almost overlapping here. So this is GOVT and LQD, so that's government bonds and corporate bonds. And then you got high yield, which is also moving in the same direction, but a little bit disconnected from these two. The overall picture here is that money is still flowing out of stocks into bonds and bond-related asset classes. As a side note, it's also moving out of commodities. So these are the tails for GSG and DJP. And as you know, these are the tails for two commodity ETFs, two commodity indices. And they are under the weather as well. And then we have finally the US dollar, which is weakening again, I should say. So back to stocks versus bonds. Money is rotating out of SPY, moving into GOVT and LQD. So from a asset class, asset allocation point of view, you should now definitely consider lowering equity exposure if you haven't done that already, and either go neutral or favor an allocation to government bonds and or corporate bonds and high yield bonds. That's the message that RRG is sending you from a rotational point of view at an asset allocation level. And from asset allocation, let's move to sector rotation. And here's the RRG showing the 11 sectors of the S&P 500. And let's look at the most important rotations. I think the one that's still standing out is the rotation out of technology. As you know, technology is the largest sector in terms of market capitalization inside the S&P 500, and money is flowing out of it, and the rotation is negative. It's at a negative heading, and it is now just crossing into the weakening quadrant, moving into lagging, passing the benchmark. What you may notice is that pretty much all other tails are pointing in the opposite direction. They're all either pointing almost due north, or they're at a strong RRG heading, meaning a tail that is moving to the northeast between 0 and 90 degrees. And that's quite rare. So everything is rotating out of technology, or at least the relative trend of technology is moving lower, is rolling over. All the tails that are on the left-hand side, by the way, are in a relative downtrend, but they seem to have come to a standstill, and some of them are picking up, and a few of them are actually in the process of curling back up. And now we've got utilities on the right-hand side. If you just would use the odds ratio as a metric, that is now the strongest sector in the S&P 500. A very defensive sector, let's say that. But if I look at the other rotations, then it's especially healthcare, staples, real estate that are on a positive streak. And it doesn't necessarily mean that they are raking in positive returns from a price level, but they're improving versus the S&P 500, and they're definitely improving versus the technology sector. And maybe you ask, why are you not including consumer discretionary, the X and Y tail right here? And that's because that tail is actually, look at the distance between the nodes for something like real estate or healthcare and even for consumer staples. These distances are growing. That means a positive ROG velocity. It's the distance between the nodes. Look at the length of the tail. Look at the length of the tail of, say, for healthcare and for real estate. And maybe also staples, because it has this little hook in there. So if you would stretch them all together, it's also a decent sized tail. Consumer discretionary is way shorter. And what you see here is that the distance between the nodes is decreasing. That means that the power behind that move is decreasing, is coming to a standstill, rolling over. And you can see that here in the last 2 weeks, the RS momentum scale, so the tail did not pick up on the RS momentum scale. So it's losing, or, well, it's not gaining anymore on the RS momentum scale. It's stable. But it's stable inside the improving quadrant, and it's barely moving to the right. So this is a tail that I'm watching to roll over and start curling down, back down towards the lagging quadrant. When you look at energy, industrials, materials, they're inside the lagging quadrant. They're picking up a little bit, just like financials here and communication services. But the lower they are on the odds ratio scale, the higher the odds that they are, they will eventually roll over without hitting the leading quadrant. So, with the markets under pressure in general, I think it is now important to focus on the outperforming sectors, and utilities is definitely there. That's the highest reading. Then technology, we know, is when it's rotating out, so it's right now it's quite underperforming. And then you've got communication services, which is very close to the benchmark with a very short tail, so that's a stable sector. And then you see improvements in staples, healthcare, real estate. And you see the risk in consumer discretionary of rolling over. So if you're a long-only investor and you really want to beat the benchmark, being the S&P 500, and you're happy with the possibility that even if you beat the benchmark, you're losing money from a price perspective, but you'd like to be invested in the market because maybe all of a sudden jumps up. So you want to keep your allocation there, which I think is a sensible way of doing it. Maybe you don't want to be 100% invested in stocks at the moment. I mean, we looked at the asset allocation RRG, and that doesn't warrant a full allocation to stocks. So that asset allocation RRG uses EVINX as a benchmark, which is a 60-40 benchmark. So if you're a very conservative investor, you may want to go mutual, meaning that you want to invest 60% in stocks and 40% in bonds. If you want to go with the observations from the RRG, you may want to go 50-50 or 40% stocks, 60% bonds, which is a decent allocation to bonds over stocks. Basically executing on the observation that stocks are now underperforming bonds. But even if such a strategy, it means that you need to have an allocation of 40 or 50% or whatever you decide on to the stock market. And where do you want to allocate that money? Well, that's where RRG comes in. And I think that right now you want to allocate that money to utilities, to staples, healthcare, and real estate. I think those are the 4 sectors that are best positioned to beat the S&P 500, even if it means that you may have a little loss on your equity allocation. Nevertheless, if the market quickly reverses and shoots up for whatever reason, you still have your 40% allocation in stocks. And even though they may not catch up with the market as a whole, that will bring in some equity returns in that part of your portfolio. Let's take a look at the inside of a few of those sectors and see if we can make up and narrow the groups down a little bit more. In order to dive into the performance of the various sectors and see a more granular breakdown, I go to the sector summary. If you click on the sector summary widget on that page, you will get a table that lists all the sectors with some information. But what's important for me is the RRG icon here at the right. When I click that, I get a breakdown of the industries inside that sector. So let's start with the utilities, because they were far away on the right. They are the strongest performing sector at the moment in relative perspective. And here are the industries inside the utilities sector. And I also have the utility sector right here, so you can see how they're positioned. The benchmark here is the S&P 500. Now, I already know that the utility sector is hooking back up while inside the weakening pattern. So to make it more specific, I'm going to set the benchmark to XLU. What that actually does, it will transfer this node here to the center of the chart. And you will see when I hit update that it will change the constellation of the chart. Watch this. So now we have the industries inside the utility sector compared to the utilities sector index. I can take that one off so my chart is nice and clean. And what I see here is that the water index is just crossing over into the leader warning, and that the conventional electricity index, it's the yellow one, it's inside weakening, is rotating out. So what this tells me is that conventional electricity index has been leading the charge for utilities. Seeing this, it started at the end of February, been leading the charge since the end of February. Then it started to roll over here in June, and then you see that water started to pick up. So at that time, within the sector, money was flowing out of electricity into the water index. And that process continued and continues until this day. You can see that the last week, but this is only 1 day of trading, that move has actually slowed down a little bit. But you can see how other groups like gas distribution and multi-utilities are now actually picking up. And knowing that pretty much the entire sector is improving against the S&P 500, again, from a portfolio approach, from a portfolio level, I would now start to look for individual stocks in either one of those three groups, spread them out over those three groups. And you can actually find those stocks by using the advanced scan engine, and you can sort through the members of these industries. Let's take another one. Let's look at healthcare. We look at healthcare. So look at the healthcare sector. Again, we go to the RRG. Here are all the sectors versus the S&P 500. So you can see the overall improvement for the healthcare sector as a whole. And here's healthcare. Here's XLV. And I'm going to do the same as I did with utilities. I'm now going to change the chart with the benchmark to XLV. And if I update this one, and now I can take XLV out of the equation because it's centered my chart, and I got a very granular look at what's happening inside the healthcare sector. And very clearly, the biotech index is now the preferred group. So biotech, and then here is healthcare providers, HP. These are the ones that are gaining on both axes. They have a positive RRG heading. And what you also see, what we just saw with conventional electricity in utilities, you see that here with the pharmaceuticals index. This is the one that led the charge going into the strong performance for the healthcare sector. So here you see medical equipment rotating out, and then medical supplies and pharmaceuticals are rotating in. And this is all happening. You can see that here, March 25th, week of March 25th. You scroll forward, and you can see how first we saw some rotation out of pharma, out of medical supplies. All of a sudden, we got this hook back, and this was May 20. The hook back up. And now you can see the improvement, or you saw the improvement of that pharmaceutical sector until mid-July, and then it started to roll over. It was taken over by biotech, and here is healthcare providers. And that is the rotation that we are now currently in. So the pharmaceuticals seem to have done their job. The chart, by the way, of the pharmaceuticals index still looking pretty good. But inside the healthcare sector, so, pharmaceuticals, biotech, healthcare, they're all beating the S&P 500. They're all pretty good charts compared to the S&P 500. If you go granular and you go into the healthcare sector, I think your preference should be with the biotech index and the healthcare providers index. And this is where our shopping list should come from. If we want to have stocks, if we want to have individual names that are beating the S&P 500, because we know about the healthcare sector itself, XLV is already beating the S&P 500. So biotech and healthcare providers are the groups inside the healthcare sector that I would pay attention to. And let me bring in the chart for the biotech index, just to look at it with the chart. You can do that by just clicking on the candle icon. And what I do is I hold control, and then click, because it then opens a new tab. This override my RRG, which I like to keep open. So here is this is a daily chart, opens with a daily chart. We're going to put it in a RRG versus the S&P 500. That's the one right here. So here's the group. You can see that we ran into this massive overhead resistance, which was respected. So this was back in 2021. But more importantly, we took out this overhead resistance here around 29.13, 29.10. We rallied to the next level of resistance. And now that old resistance here was expected to start acting as support. And so far, it's doing a great job. And you can see how the improvement versus the S&P 500 has started to gain ground. You want to change that to the comparison with XLV, as I just did that on my chart. I need to change the benchmark here and update my chart. And now I see this chart here compared to XLV. So now I'm comparing biotech against the healthcare sector. And you can see how it's coming out of that long stretched sideways move. It's not really there yet, but if you take out the 3100, that's a very important level for biotech. If that can be broken, that'll be a very good sign for the biotech industry. That will actually take it out of this range. And if we stay within the range, you can see how both RRG lines are now pushing higher and sending the biotech group into the leading quadrant, making it one of the more interesting groups within the healthcare sector. And the healthcare sector itself is already an interesting group against the S&P 500. And let me wrap up this week's video with a quick look at the chart of SPY in the S&P 500. This is my daily chart. So let me start with the weekly actually. So here's my weekly chart. And I wrote about this in the blog, and I talked about this, and this is my go-to chart for my weekly S&P developments. And so far, this big week down last week ended exactly at the former rising resistance line, which is now acting as support. So with that regard, it's still good. If this is a new low, I'm going to say this is a high mean. But we don't know that for sure yet. We could get, move lower, or we could get and put in a new lower high first. That all is still up in the air, and we need to see how it's going. So for the time being, we can't say for sure that this is a new high or low. It's still up in the air. When I look at my daily chart, I got more information. And remember, the sector rotation that we currently see is definitely defensive in nature. I got that in the back of my mind when I read this S&P chart. And as you know, we broke that rising trend, and that happened back at the end of July, 24th of July. We closed the gap, and the gap dated back to mid-June, 12th of June, and that the bottom of that gap became support, and we got a rally. And then we saw how this old rising support line started to act as resistance. So old support came back as resistance, and we put in a lower high. So we broke the trend and we put in a new lower high. And then we got this very bad week. And that over the weekend, Monday, so the end of that week and then the start of last week, actually took the S&P, or took SPY from 555 all the way down to 510. It's a decent decline in a couple of days. What it also did is actually it breached that, at that time, still support zone, which gave way, and it then tested this horizontal former resistance, now support, with this one big dip. And out of that, we're now rallying. So, in my view, this old support zone is now a very important resistance area. So the area between, let's say, 537.5 and 540 is the area where we expect new supplies to come. That's a resistance zone, and it looks to be pretty decent and an important resistance. Because if we put in a new lower high here, and we see the market going around again, we are in a confirmed downtrend of lower highs and lower lows. We will very likely again target the 510 now new support area. And if that breaks, we'll see a continuation of that move lower. On the other hand, if the market is really strong, and this is actually the end of the corrective move, then we need to break through this resistance area and we need to start moving higher. And all of that is very likely starting to happen in the next couple of days. So I think that this week is pretty crucial in how it can give us new information on the rhythm of lower highs, lower lows, or the breach of that rhythm of lower highs and lower lows, and start looking to the upside again. Right now, for me, it's a bit up in the air. I'm going to watch that resistance zone very clearly. Given the defensive rotation on the sector rotation level, I'm actually biased to see a new lower high to be formed in that 537.5, 540 area, and then a move lower with at least another test of 510 and see if that holds, so we can start building from there. And if it breaks, obviously we're in for much more declines. But that's too early to call. So right now, I think that this week, the coming 4 days, because this is already Monday, and you can see that the S&P is almost unchanged. So we didn't even reach that overhead resistance area. If we put in that, I'm going to expect us to put in a new high either in that area or lower. Now remember, the lower that new lower high comes in, the more negative the implications are, because it means that sellers are coming back early. Then they don't want to wait until we hit that resistance zone. So supply comes back early. Again, this week's crucial. Next 4 days of trading will very likely give us a clue whether we will see a new peak being formed somewhere in this area, or I don't know what is coming this week. We breach that area, we'll move higher, and then we start looking for new upside movement. But we'll see that. We'll be speaking to you when that happens next week. For the time being, I'm looking for a new lower high to get back in place
in that 537.5, 540 area, maybe even lower. Be careful with full-fledged allocations to the stock market. If you want to outperform, look at the sectors and the industries that we just discussed while we're looking at the RGs. Thanks for watching. And we always love the comments, so keep them coming. We'll engage with you. And if you've got any questions, I'm happy to talk to you. And otherwise, I'm looking forward to seeing you again next week, same time, same place.